Hello and welcome back to another episode of the For the Property Investor podcast. And we're here with the weekly news. And the only man that brings us the news is Nick Bendel, of course. Hello, Nick.
Hello, Owen. Great to join you again.
Thank you. And how's your week been in the last week, funnily enough?
Yes, my week lasted exactly a week and it was enjoyable and productive. I'm a Sydney boy. I travelled to Brisbane for a few days for a conference, met a lot of good people. I'm now back in Sydney, had a few coffees, had a few lunches in between. So that was enjoyable. And as you know, Owen, I own a business called Hunter and Scribe, which is a copywriting agency that writes content for dozens of brokers around Australia. And last week I got contacted by a broker who wants help providing his company with blogs, LinkedIn posts, email newsletters, and video scripts each month so he can just put his marketing on autopilot and grow his business. So I look forward to working with him.
Great. Fantastic. Well done. And yes, it's been a busy week for us in the last week as well at Leifield. In property management, it's always a busy week. And it was BAS month. Anyone in business for themselves would know that it's BAS month. So had to put my hands deep into my pockets to pay those tax bills. But apart from that, we were busy being productive with more managements coming on and getting lots of properties leased. So it's a good spread at the moment. Lots is happening. Units in Melbourne, funnily enough, are a little oversupplied, especially on the lower end, one-bedroom units. So there's quite a bit across the board, across Metro Melbourne, where there's quite a few units on the board. So it's we're seeing that rents may need to come down a little bit in those areas for those types of properties. So interesting to see how the market is moving.
Indeed. I had a chat with the buyer's agent last week. This is a borderless buyer's agent. He's licensed in every state and he moves from location to location depending on market trends and prices. And I asked him where he was buying at the moment, and he happened to mention he was buying houses in Melbourne, about 18 kilometres from the city centre. And he said that there had already been quite a bit of price growth, and he thought there was quite a lot of upside potential also, which was interesting. But you're talking about units, I guess, in a different part of Melbourne that appears to be oversupplied.
Yes, and it would be Melbourne's a bit of a funny market at the moment, so we'll wait and see how things pan out. Lots of changes. They've got some new taxes coming into effect, which especially all the farmers in Victoria are unhappy with. But it's affecting every property owner as well in Victoria. So, Nick, what's in the news this week? What have you brought us? Has anything significant happened in the last week?
Well, maybe one or two things. Let's start with the big news. How low will rates go? Now that the Reserve Bank has made its second rate cut of the year, speculation is already mounting about whether it will cut rates again at its next monetary policy meeting on July 8. After starting the year at 4.35%, the cash rate is now at 3.85%. All four big banks expect the cash rate to fall to 3.35% by the end of the year. And the market currently believes there's a 2 in 3 chance the RBA will cut rates at the next meeting. The RBA aims to keep trimmed mean inflation sustainably within a target band of 2 to 3%. Trimmed mean inflation was 2.9% in the March quarter after falling from 3.3% in the December quarter. The RBA's baseline forecast is for trim mean inflation to rise slightly to 2.6% by the end of the year, and for the cash rate to fall to 3.4% by the end of the year. Owen, when the RBA announced its recent rate cut, it noted that, quote, the risks to inflation have become more balanced and that, quote, upside risks appear to have diminished as international developments are expected to weigh on the economy. So the RBA is clearly less concerned about inflation than it was at the start of the year. Is that reasonable?
To a point, it is, because there's a lot of other factors, especially internationally, as just mentioned, that could have a negative effect on economic growth. So even though they're still cautious about inflation, they're also not wanting to push the economy into recession all at the same time.
Do you expect rates to fall further in 2025?
If everything stays the same, it seems that it's likely that there will be a further rate cut or two. But when it comes to the economy, nothing is likely. So it's a wait and see. And yes, it'll be an interesting year. We're teetering on the edge.
Well, speaking of the economy, we've spoken in previous podcasts about the danger of the RBA cutting too much rather than too little. But I'm wondering, has this now changed? Given the state of the economy, is the bigger danger now that the RBA keeps rates too high rather than too low?
Well, I guess that's why they're making these initial cuts now, while it looks like there's danger of rates being too high for too long, and I think they're going to sit on their hands for a little bit now to see how these two initial rate cuts have an effect. And what I'd like to see, though, is a small trim, or an extra little trim to the next rate cut, to just even up the rate by that extra 0.1%. Yeah, because it's just off by that 0.1%. So we yeah, you actually have to get your calculator out to work it out, instead of knowing the next quarter that it's going to come down. It's Yeah, we're covering off the big issues here, Nick.
We certainly are. I think that's the definition of first world problems. You may recall back in 2020 during the pandemic, the RBA made a few emergency rate cuts and the cash rate was at 0.25, and then they wanted to cut it again and they felt they couldn't go to zero, so they went to 0.1. And that's why we're in this sorry position that we're in now, where the maths just seems a little wonky.
Yes, it's just like, well, when they were raising rates, couldn't they have just, worked it out at that point and made it nice and simple, gone from 0.1 to 1%, or half, for the first go? Yeah, it's just making it difficult for us.
Well, of course, the RBA can move the cash rate by whatever number it wants. So maybe the next rate cut, if and when it comes, instead of doing, say, 25 basis points, maybe they should do, I don't know, 18.76 basis points, just to screw with all of us.
Yes, no, that would be even more confusing, Nick. I mean, I've only got 10 fingers and 10 toes.
You are a simple man, but that's why we love you. Let's move on to the next story. Broking industry hits back at the AFR. The Chanticleer column in the Australian Financial Review has raised the idea of banks offering cheaper mortgages to customers who bypass brokers and go straight to their branches. Chanticleer says that instead of paying brokers a commission, banks will give half of that to customers and keep half for themselves, thereby improving their bottom line and benefiting customers at the same time. However, Lendy Group CEO David Hyman said, I'm sure bank investors like that idea. The thing is, Australia has already run that experiment extensively, and consumers have voted with their feet in the opposite direction time and again. Loan Market Group Chairman Sam White said, let's be clear, brokers have driven competition. We've opened up the market, brought in choice, and created better outcomes for everyday Australians. We stopped the loyalty tax dead in its tracks. But articles like this want to drag us back to a time when customers had fewer options and ended up paying more. It's getting really tiring. Owen, Chanticleer says that if borrowers just stopped using brokers and returned to bank branches, the banks would be glad to offer them cheaper mortgages in return. Is Chanticleer right?
Who is this Chanticleer? Is it a person? Is it a group? Is it an organization? Educate me, Nick.
It's the name of a recurring column in the AFR.
Right, okay.
I've forgotten the name of the journalist who does it, but there was a previous Chanticleer, and when this journo eventually stops doing it, there will be a new Chanticleer.
Right, okay. Yeah, it's yeah. What planet do they live on? Yeah, it's like seriously. Some of these journalists and apart from present company, of course. Seriously, they got no idea about the real world. They are they. It really surprises me that they're writing for the AFR because they're expected to have some kind of basic understanding of the economy and markets, especially finance markets. And it's been well and truly documented and proven about the value that the mortgage broking market provides, and and also uh, the value that mortgage brokers provide to the banks in terms of saving them money. So if they were to, so banks just couldn't, reduce by the amount of commission and provide that to the borrower, because they would be incurring the direct costs themselves that mortgage brokers are saving the banks. So yeah, they obviously got no idea. So maybe they should go write for the Guardian or something.
Well, you make a really good point about brokers saving the banks money by doing their distribution for them. And the idea of borrowers just going back to the branches, besides the fact that they don't want to, banks are actually closing their branches. And of course, before the growth of the mortgage broker channel over the past 30 years or so, banks were charging higher interest rates, not lower interest rates.
Yeah, exactly. So it's the brokers that are adding value. So yeah, obviously a journalist that's under 30 years old and has got no idea.
Well, let's do a thought experiment. Imagine if brokers disappeared from the market. What would that mean for consumers?
It would mean that the banks could start making more margins out of home loans, and probably quadruple what they are now, and which they would love. So it would mean more expensive rates. And yes, it's, even though we've seen a large consolidation of banks in this country in the last, say, 30, 40 years. At the same time, we've seen a lot of movement between those banks by customers. So, and that's solely due to the mortgage broking market. And mortgage brokers provide that value of allowing the consumer to be able to get the right loan at the best rate for them at that time. And that can change from year to year, or even month to month, between different lenders and different banks.
You make a really good point about how if there were no brokers, home loan rates would be higher. It's interesting when you look into the data, borrowers who go direct to the lender tend to use a big four bank far more than borrowers who take out a mortgage via a broker. If you're a consumer and you're going direct to lender, getting a mortgage can be confusing, and it would be natural in that situation to go with a big brand name that seems familiar and maybe you've already got an account there. But if you go to a broker who holds your hand through the process and who compares the market for you, they can point out, well, hang on, Owen, I know you thought maybe you should go with CBA or ANZ, but here are a few other options where the loans are not only better, they're also going to give you a lower interest rate. So what about we go with one of those options instead? So if we got rid of brokers, I think you make a great point. I think the big four banks would love it because they'd be getting so many more customers than they do today, and they could charge them higher prices, but it wouldn't be as good for consumers.
Absolutely. You're 100% right, Nick.
Well, I love it when people tell me that. Music to my ears, and all the mortgages I've ever gotten in my life, I've done it through a broker. I just do not understand why people would ever go direct to lender. But look, maybe I'm biased. I know we both love brokers, but there's a reason we love brokers, and that's because we believe wholeheartedly the things we're saying, that the brokers deliver us better outcomes and better outcomes for everyone else. And that would explain, I think, why broker market share just keeps rising year after year. And yet, strangely, Owen, these anti-broker arguments refuse to disappear. Well, why do you think that is?
Oh, it's quite possibly just propaganda funded by the banking industry to try and keep a question of doubt in the marketplace, and they'll pick on any negative that has happened between a customer and a broker to be able to say, look, over there, brokers aren't as good as us. You should come use us directly. So yes, it's hey, I don't blame them. They're trying to protect their business and their industry, and they have just as much right to do that, but as brokers do to say how good they are and how bad banks are. So, but what proves who is right is the consumer, and the consumer wholeheartedly votes with their feet and their dollars and says, no, I'm going with the broker.
Well, I think we have hopefully set the issue straight, and hopefully Chanticleer listens to this podcast, Owen.
Yes, well, and maybe they need to reinvent themselves.
Well, let's move on to our final story. Government housing supply target looks shaky. Australia is headed for a major housing supply shortfall, according to the latest State of the Housing System 2025 report from the National Housing Supply and Affordability Council. Under the federal government's National Housing Accord, the federal government is aiming to facilitate the construction of 1.2 million new homes in the 5 years to June 2029. But current projections show just 938,000 completions, a shortfall of 262,000. Furthermore, just 177,000 homes were completed in 2024, compared to an estimated demand of 223,000, one of the lowest supply levels in a decade. Oh, and I know we've talked about this a lot. Are you surprised that the federal government appears likely to fall short of its target to deliver 1.2 million new homes in the 5 years to June 2029?
Absolutely not. Not surprised at all. It was they were never going to get there, and in the meantime, they've been too distracted by boosting our immigration in the last 3 years, which has very much so increased the demand on the housing market, which exacerbates the need for this extra supply. But I think their priorities have been in other places to try and undermine our democracy and stack the political votes in their favour where they want it. So it's did I just say that? Geez, Nick. It's the government's priorities are in such unusual places. They've lost it.
There is another election scheduled for 2028, but if Labor is still in power in June 2029 and the 1.2 million home target has not been achieved by then, can we ask for our money back?
Oh, many a public have asked that after many elections, and yeah, it's hey, it's they're bringing in new taxes against unrealized capital gains in super, but providing many exemptions, including themselves. So yes, it's we're not even getting the money from them in the first place.
Now, according to my maths, we're on target to build only 78% of the homes required by June 2029. Is there anything the government could do to hit its target? Is there any way they can dramatically increase the amount of new housing that gets built over the next 4 years?
The biggest issue is the red tape to be able to get these developments approved, and the other big issue is that government can control is the taxes on new developments. So both federal, state, and local, if they got them all together and worked out a deal to be able to reduce that cost on new construction, then it would make life a lot easier for the marketplace to go out there and provide more supply for themselves.
Well, this is interesting because the government over the past 3 years or so has spoken so often about its determination to increase housing supply. And maybe I'm not as cynical as you. I do think they believe it, or at least partly believe it. In other words, I do think they genuinely want to increase housing supply, and yet they don't appear to be taking the steps necessary. So you talked about reducing red tape and lowering taxes. Reducing red tape is a harder thing to do because it requires more work. Lowering taxes, though, is just something you can do with a stroke of a pen. So then why do you think they haven't reduced taxes in order to stimulate more housing construction?
Because they want to control the process. Everything that this government is doing is about putting more levels of control over the country and the population and how it's run. So their main focus seems to be towards build-to-rent schemes where they can do large developments funded by their industry super fund mates, where their mates in the CFMEU can then make sure that all of their union-paying members can have jobs. And because it's funded by super funds, who cares how much it costs, as long as it all gets built. So they all get fat on the money, and so that seems to be where they think they will solve this big, massive problem, and they will solve this housing crisis. But yes, so yeah, call me skeptical if you want, Nick, but it seems to be what they're proving is correct.
Well, given your criticisms, it sounds like you're already regretting your recent decision to vote for Anthony Albanese at the recent election.
Um, Nick, that's libel and slander. It's it's I'm gonna go call my lawyer now.
Okay, well, I will see you in court, Owen, but in the meantime, it's been great chatting with you. Thank you for the insights you always bring, and I look forward to chatting either in the next podcast episode or in court.
Thanks, Nick. And you know what? I'll let it slide for this time. I know you're joking. So, all right, we'll see you next week, Nick. Thanks for bringing the news. See ya.